why stop-loss trading is so important, and strategies to use. If you're serious about your trading career, you need to use stop-losses in every single trade that you're taking. Now that you know how important they are, it's time to shed some more light on stop-loss orders, explain why you need to use them, describe the main types of stop-losses and show you how to incorporate them into your trading strategy. A stop-loss order is an order that automatically closes a losing position once the price hits the pre-specified level. You don't want to hold the stock if the price falls to $45, so want to sell it and close your position at that level. There are two ways to do it. You can either follow the price and close the trade manually as soon as the price falls to $45, which is a so-called mental stop, or you could simply place a stop-loss level at $45 which automatically closes your trade when the price reaches your order. Basically, when the price reaches the level pre-specified in a stop-loss order, the order becomes a buy market order when used with a short position, and a sell market order when used with a long position. If you're not using stop-losses, it's only a matter of time when a large losing position will get out of control and wipe out most of your trading profits, eventually even your entire account. If you're serious about staying in the game in the long run and growing your trading account, it's necessary to use stop-loss orders in every single trade you're taking. We'll go in much more detail on how to incorporate stop-losses into your trading strategy later in this article. Now, let's go through the main types of stop-loss orders you need to be aware of. While a stop-loss order is always a stop-loss order, they differ in the way how traders are using them. Depending on how traders identify potential stop-loss levels, there are four main types of stop-losses: charts stops, volatility stops, time stops, and percentage stops. Chart stops are arguably the most popular way to use stop-loss orders. A trader who is looking to go long would place a chart stop just below an important technical level. By placing a stop-loss just below that level, such as in the case of horizontal support levels, a position will be automatically closed if that level breaks. Similarly, traders who want to go short would place a chart stop just above an important technical level. Resistance zones are expected to hold an increased number of sell orders which can reverse the price. If an important resistance level gets broken, a trader doesn't want to stay inside a short position anyways, and the stop-loss order will automatically close his or her trade. Chart stops usually return the best results among all other stop-loss types, which is why you should look to adopt them too in your trading strategy. Unlike chart stops, volatility stops are based on the volatility of the financial instrument you're looking to trade. A volatile market has large price changes in relatively short periods of time, while the absence of volatility means that the market doesn't move at all. Volatility stops look at the volatility of a financial instrument to base your stop-loss level on. Traders who are using volatility stops can look to place their stops just outside the bands. Traders can use the ATR reading to set their stop-loss outside the average range, making sure that they don't get stopped out by simple market noise. Time stops are best combined with other types of stop-loss levels. Finally, percentage stops are based on a percentage of your trading account to limit the total risk of a trade. For example, a trader with a $10,000 account who wants to risk 3% of his trading account on a single trade could place a stop-loss at a level that ensures his total potential loss is $300. Some traders might think that percentage stops are a good way to manage and limit losses in the market. However, bear in mind that percentage stops imply placing a stop-loss at an arbitrary level, as long as the total potential loss doesn't exceed a percentage of the trading account. Trailing stops automatically move the underlying stop-loss level with each tick of the price that goes in your favor. However, if the price reverses and starts to go against you, a trailing stop will stay at its most recent level, limiting your losses or locking in unrealized profits. Stop losses play an integral part in any well-rounded trading plan and risk management. Here are a few tips on how to incorporate stop loss in your daily trading routine to maximize profits while simultaneously reducing risks. Place stop losses at important support and resistance zones. Among all other stop loss types, except trailing stops, chart stops are the most effective way to use stop loss orders in your trading. To use chart stops, first you need to identify important technical levels, usually support and resistance zones, in the chart. Besides horizontal support and resistance levels, you can also use trend lines, channels, Fibonacci, pivots, or any other technical tool you want. The key here is to place stop losses above/below those levels and not exactly on them. Use trailing stops in trend-following strategies. Trailing stops are stop-loss orders that automatically trail the price with each tick that it goes in your favor. Another popular risk management technique is to lock in unrealized profits by moving your stop-loss level in a profitable trade. Calculate your position size based on your stop-loss. Position sizing deserves a special place in your risk management and trading plan for a reason. Position sizing refers to calculating your position relative to the risk you're taking, and stop losses play an important role in this. Successful traders always expect to make a larger profit than their potential loss. Over the long run, this could have a negative impact on your trading performance, as would need to have a success rate of more than 50% to make a profit. Naturally, just like stop-loss orders, take-profit orders should also be based on important technical levels. Place your take profits a few pips below an important resistance, when going long, and a few pips above an important support, when going short, because you don't want the price to reverse before your take profit gets triggered.